Good evening, TheoTrade. This is Corey Rosenblum, and you're watching the Theo Nightly video for the 14th of July here in 2020, which means the year 2020, as strangely as it is about halfway over. So we'll take a look now at the S&P. We only thought the market could go down, right? 2 days in a row. If we only get 2 days in a row down, if only. Yet here we are with a market that did pull back into the profile levels, pulled back in our weekly expected move, and things were going really well yesterday, especially the Nasdaq. See, that got downside targets, moving averages, all the pullbacks. We'll go through all these momentarily, but the theme of tonight's video is one day. It's all we get. Really? Yeah, unfortunately, one day is all we get. The market has been in uptrend mode, and where we're coming off here in the middle of July is this monster rally in the Nasdaq itself. Now, I'm comparing this to the prior times where, really in May, multiple up days in a row, one big down day. And that took us to the target, or the pullback point, which is your 20-day exponential average. And that's where we hit today, and then rallied up away from. And then we had the movement 1, 2, 3, 4, 5, 6, almost 7 days to the upside. 2 down days, not back to back though. If we don't count that little thing right here, we have 1, 2, 3, 4, 5. We kind of ignore that too. 6, 7, 8, 9. And then yesterday was a big down day. So it is logical to get down days. It is expected. It is everything. Probability is and more. But it might be all we get. So please, please, please pay attention to these charts, the progression of the upside, and of course any open positions. So in terms of the S&P, we are not at all-time highs. In fact, the market's piercing the 3200 level. And that's going to be key for tomorrow's session and the rest of the week. We are still in a headline minefield. And things about China, things about the coronavirus and lockdowns, shutdowns, all the thing else, GDP, unemployment. Numbers are hitting the tape at all points in time. But we still have this upward creep. So balance the headline news and how much the market should pull back with the reality of supply demand and just probabilities. Something that has a 20% chance of happening happens 2 times out of 10. A market that should pull back deeper, but doesn't. Sometimes that thing keeps going. Or in this case, a market that should bounce a little stronger than a couple sessions doesn't really bounce. So it works both ways. It's not just a bull bear type of indication or update or evening video. It's this persistence of trend or persistence of movement with nary a pullback or small type of pullback. So we'll continue. We are back in this, again, 3200 level in the S&P, which happens to be, we'll go through profile levels next. It happens to be a critical point. It is roughly the prior high from June, and it's just a round number reference point. The market is and remains, from a probability standpoint, bearish, cautious, defensive, while beneath. And you can see how the risk gets very high, to the bulls at least, when the market's above 3200. We've had 2, count them, 2 drop zones. And a drop zone is a major mega point drop on an intraday basis. Now, we did have a trend day to the downside. That was the 11th of June, roughly a month ago. And that was the last significant, well, we'll count the 19th of June, down day in the market until yesterday's midday reversal. So while we're still above these averages, these are key pivot points and they're key intraday targets. They are 3120. We can see how the market pulled up away from 3,000. And I would suggest that if this 3120 and 3100 level fails or falls, we will see the market trading down to 3,000. And that's a key spot too. Reference and place spreads or different put positions. In the SPY, your key reference points are 320, roughly 3200. Again, that moving average, 312, just keeping it simple. And then 300. That's going to translate very well into the SPY and ES levels. On your Nasdaq, however, the monsters of tech, titans of tech, and these are your Google, Amazon, Facebook, etc., they keep getting stronger, and notice where they are relative to the earlier point in 2020 before the coronavirus actually shut the economy down for the first time. And the monster as a tech symbol was roughly at the 9,500 index level. And the Nasdaq was roughly at the 9,800 index level, and we're well above that. Key reference points again for the Nasdaq is 11,000, and the moving average 10,400. And that's just the last couple of times, four times the market has pulled back or retraced. It's done so into the 20-day moving average. The Dow is a little bit different. It was stronger in part because Caterpillar and some other stocks, McDonald's and UNH, United Healthcare, had a large dollar gain in today's session, and that lifted up the Dow a little stronger percent-wise and point-wise for that matter than the other indices. Outside of that was a Russell, which continues to form a weak, compressed triangle. Not quite as strong as the Nasdaq, clearly, or the S&P. So the strongest sector today was the energy sector, which is not saying a whole lot. Now, all that being said, your levels to watch is kind of summing up the video. Your prior highs, 3200, and your support bounces at about 3120. That's going to be planning out the rest of this week with headline news events and other types of volatility. Let's stop talking about stocks for just a moment here and take a look at crude oil. This tracks the equity market, or at least is an economically sensitive commodity, such that the economy does well, crude oil does well. The economy does poorly, crude oil does poorly, and that's in part because of transportation or energy cost. If nobody's traveling, nobody can do business trips, nobody can take vacations, crude oil with the equity market tends to plunge. And if we are going to recover, crude oil is going to recover with the market and the economy. The same is true if the equity market starts to fall, if we tumble back into a recession, or debatable if we ever left it, if we tumble back into the negative headlines and negative jobs rates and those sort of things, you would expect equities to fall and crude to take a downside plunge with it. And that could go to 30 or lower. That might be bullish on the opposite side for gold. We've had some good trades. I know Don has had some in-out spreads or had some iron condors, long, bullish iron condors for gold, and they have played out well. Same thing for the bond market. When gold goes up and it's sustaining above 1800, that tends to be a risk off, meaning money is rotating from the equity market into more stable or safe products. Gold is one of them. The other is the bond market. So unlike equities, we're looking for a support type of play or support type of environment above 1785 or even above 1800. And if that fails, that's the pathway bullish for the equity market. Is if gold starts to break under 1700 or 1790 and a little bit lower, that's going to probably boost the equity market higher. Similarly, in this is case ZN, which is your bond market, it has an overhead wall of resistance at about the 140 level. So if bonds ever caught fire and rallied strongly above, well, that's probably going to correspond with money flowing out of the equity market. So a bear swing and a sell swing lower in the equity market, which is going to juice the bond market higher and probably make new highs with gold. So maybe that's the purpose of the video for tonight. Taking a look at equities into resistance, and then bonds and gold, which could break higher. So one of the two things will happen. Equity markets and stock markets pull back and go lower, in which case bonds and gold probably shoot a lot higher, which is your bull type of spread trades on it. And the logic for TLT breakout, which is already in motion. But if that doesn't happen, if the equity market holds support and continues up higher, you might see the Treasury market stall and gold turn down from resistance. So that's not a prediction, but looking at probabilities and how the intermarket relationships and money flow go together. And then from that, you can structure your trades however you see fit. If you're an equity trader, a TLT swing trader, bond trader, gold, GLD, GC, and of course maybe even crude oil as well. But always watch your levels, watch your spots, keep the bias. I understand we're all bearish. We all are protective and defensive. But if this market catches a bid above 3,200, it won't be far away to see 3,300 and higher. And if that seems a far reach, certainly is, let's again reference the Nasdaq at this point in time, where we had a very similar conversation. If the Nasdaq keeps catching fire, keeps bidding up, we can see it above these all-time highs, which eventually we did. So that's your market bull thesis, or continuity higher thesis, and otherwise, caution remains. Key spot 3,200. As always, be careful and safe. This is Corey Rosenblum with tonight's Theo video for the 14th of July, 2020.